Okay, today we're going to talk about tips to improve the inverse head and shoulders chart pattern searches. This is a very important pattern in that it indicates bottoming action. So it's a little bit different than other AutoChartist patterns in that it gives a direction with confidence based on historical tendencies and long-term chart analysis. So today we're going to start with the disclaimer, and I want to say that AutoChartist service includes chart pattern identification in respect of foreign currencies, commodities, equities, and stocks. There are potential risks relating to investing and trading, and you must be aware of such risks and familiarize yourself in regard to such risks and to seek independent advice relating thereto. You should not trade with money that you cannot afford to lose. The AutoChartist service and its content should not be construed as a solicitation to invest and or trade. You should seek independent advice in this regard. Past performance is not indicative of future performance. No representation is being made that any results discussed within the service and its related media content will be achieved. All opinions, news, research, analysis, prices, and other information is provided as general market commentary and not as investment advice. AutoChartist, MDIO software, their members, shareholders, employees, agents, representatives, and resellers do not warrant the completeness, accuracy, or timeliness of the information supplied, and they shall not be liable for any loss or damages, consequential or otherwise, which may arise from the use or reliance of the AutoChartist service and its content. Okay, now that that legal work is out of the way, I want you to know that I think you should stick around for this. It should be an exciting webinar because we're going to overlap the New York openings. So towards the end, we're going to be watching for potential fresh signals developing in New York stocks, just to show you some of the power behind the AutoChartist chart program. So it's very important that you stay in your seats. The room is full. And again, stick around to the end because we'll have that New York opening and tend to get a lot of activity on the opening, which again can be reflected in AutoChartist fresh signals. Okay, what we're going to talk about today is the inverse head and shoulders chart pattern, and it's going to be broken down into a basic understanding of what the pattern looks like and what the characteristics are, and to give you a little bit of insight on how the AutoChartist program finds this pattern when it does its searches. We're also going to talk about how to create the chart pattern search so that if you have AutoChartist, you can create a filter where this particular pattern comes up exclusively. And we're going to talk about the trading rules involved when you get a completed pattern, how to approach it as a trader. And we're going to then look at some chart examples at the end, but like I said, throughout this particular webinar, we're going to be working primarily with live data because we are getting good trading activity in the marketplace. So what we're going to do is I'll go through the webinar using the stock index futures because there's a lot of overlap going on between the European sessions and the U.S. sessions, so we may be able to see some fresh activity taking place, especially when the U.S. opens up. Okay, right now we're looking at a complete chart pattern for the French 40 CFD. For those of you who have taken the intro webinars, just a little bit of a recap, we have emerging patterns on the right side. Those are patterns that have potential setups for this inverse head and shoulders pattern, and the completed side are patterns that have shown us the breakout and have confirmed that the pattern is working or in a position to rally or break out. So what we see here is that on August 24th, which was yesterday, we did get a breakout, and this is the activity that we've seen overnight. Not only did it hit its target zone here that AutoChartist identified, but it's even moved higher. So we'll be waiting to see throughout the session if we get fresh signals as the especially after that New York market opens. Now, one thing that you want to note about the inverse head and shoulders pattern is that it's probably one of the most reliable chart patterns that we have. It's pretty clear. It's very appealing to the eye. It's a very visual pattern, just like its cousin pattern, the head and shoulders pattern. But the inverse pattern is an accumulative pattern, or it indicates accumulation. And for those who aren't familiar with the term, you have accumulation, which means it's setting up a buying opportunity. Traders are trying to accumulate stock or currency or commodity, versus the head and shoulders, which is distributive, which is a pattern that shows topping formations. So when you get a head and shoulders pattern at an extreme level, say you're doing normal chart analysis where you're looking at support or resistance levels, maybe something historically important zone. When you see a market enter into that zone, then you may want to look at your inverse head and shoulders pattern to see that something is setting up. Another thing that's good about the inverse head and shoulders pattern is that you get a base formed before the market goes. And that's very important because a lot of times you'll see a bottom form without a base. It would be like a spike bottom, and those markets tend to have abrupt endings after they break out. They tend to indicate more short covering, whereas something that builds a base is more indicative of accumulation, as I said before. So you want to look for that characteristic base anytime you're looking for a buy pattern, and then that's why this inverse head and shoulders is very powerful. It's a very simple pattern to look at. If you can imagine a market coming down after a prolonged move down in terms of price and time, driving into this area here, this is known as the left shoulder. Okay, so after the market comes down into this left shoulder, it rallies up, maybe shakes out a few of the shorts, but then maybe a few more shorts come in, some fresh shorts come in, while the weaker shorts are getting out, and they drive the market one more time in an attempt to break it lower and continue the move. And the market then comes to an abrupt end here and forms the head of the pattern, and then rallies back up again to this previous high before breaking back down. So what you have here is a formation of a shoulder here and another shoulder here, and these lines are connected automatically by AutoChartist to identify this as the shoulder point. And up here, the resistance is connected at the neckline, and that creates the pattern. You have your resistance as the neckline, as a neckline, and you have your support as the shoulders. So it's very important to note the symmetry between these two. It's again appealing to the eye when you see these almost straight line support and almost straight line resistance. You don't want to have something that's got obscure diagonals or some kind of look that looks disjointed. It should look like an inverted head and shoulders. It should again be appealing to the eye, and it should be aesthetically appealing. So when you look at the pattern in terms of trend, again, imagine that this left shoulder is the penultimate decline in a bear market. So some people think penultimate means the last decline. What it means is the decline before the last decline. So this little move down here is the penultimate decline. It's the one that traders have driven down, bearish traders have driven the market down into this area. It stopped going down. Maybe a big bid came in. Maybe some sellers lifted their offers, and the market rallies back. This type of rally is often indicative of short covering. Believe it or not, professional traders don't always hit the bottom of a market. First of all, the shorts have to get out, and once the shorts get out, then the market professionals begin to accumulate or pick their spots to get in. That's why it takes time to develop this, because when you're going to be an aggressive buyer, and say you're an institutional buyer or a mutual fund buyer, you don't want to show all your cards at one time. So you're going to try to stagger your orders. You're going to try to stagger the size of your orders. You're going to try to stagger the prices that you buy at. It's not all about trying to get the best price, but basically what they're trying to do is assess the risk of the position. And so you're going to see a lot of disguising going on as traders, professional traders, try to buy in this level. And that includes you're going to get, after this short covering, another drive lower. Now that could be set up by institutions to try to fool people into thinking this market's going to break lower. So what they do in that case is the public jumps on that particular move and starts to think that they have to get short the market while the bigger traders are waiting there with their hands open looking to buy. So that's the kind of action that goes on in the trading pits or on the in the electronic screens, that this type of action is going on. It's a clash between the bears and the bulls, between the big traders and the small traders. Okay, once the market makes its another bottom here, you get that other drive up, which is the short covering again, with perhaps a little bit of accumulation from those that started to buy as the market came back down here. And then finally, you get the head represents the final decline in a bear market, and then the bull market here begins with the right shoulder. You can see that after it makes its low, this even forms, this little 4 candlestick formation, that forms a small support base, and again is a hint at accumulation. So that would be another sign that this market could be poised to move higher. If you compare the shoulders, you'll see what I'm talking about. You see this move here was a spike down. There's no base built, so when it rallied back up, it came to an abrupt end. Here they tried to put in a couple of bottoms, but then finally when they make that final descent that fails to go down to the head, you can see that somebody is defending this support area. So again, that if you watch order flow, that could be a big buyer in there that's stopping the market from going down, allowing his traders or his company or his institution to accumulate more and more shares. Then finally, after all this is being done and shorts are getting frustrated about driving this market lower, they start to bail out of the move, and long traders as well as shorts start to cover, driving this market higher. You can see that when you have accumulation, you tend to get very narrow candlesticks, very narrow daily ranges, very narrow swings. And finally, when there's a commitment to the long side, you get bigger candlesticks and you get greater volatility. And those are all key characteristics of a accumulative pattern. So those are all the things that you want to see. And AutoChartist does all that work. It looks for, using its algorithms, it looks for conditions like that that are helping to create that particular pattern in that situation. So all you do is have to wait for an alert to go off, either as an emerging pattern or as a completed pattern, and then just react to the what AutoChartist has found. Now we have a question right now, and the question is, an inverse head and shoulders chart pattern, a cumulative pattern, true or false? Okay, that's a true or false question. Great, looks like we've got 100% true. It's beautiful. Should end right here. That's perfect. Okay, now another thing that you want to look for, and it doesn't show up on this particular chart, but it could be used in conjunction with this chart, is a volume characteristics. Volume characteristics are of critical importance in assessing the validity of an inverse head and shoulders pattern. What happens is you're usually getting normal selling activity, very heavy selling activity as this market is coming down. If you use conventional charting, or if you've read any books or studied the markets, you should note that these volatility spikes are often indicative of the end of a move. They usually call it capitulation on down moves, where there's huge spikes in volume as those traders that couldn't get short near the top finally decide to press that market in a big way, and those longs who've held on forever finally decide that their positions are wrong and they start to get out. So it's a combination of the lungs getting